So my sponsor had to go out of town, which caused me not to be able to post any videos. I'm getting hate mail. People are upset. I want to apologize, but didn't even have the time. Stick around. We're going to talk about the markets, what I see going on, and what I think we see going forward.
Want to make your money work harder? Enjoy another video with Adam Kahn, the rational investor on stocks, real estate, and crypto. Subscribe now for your weekly dose of investment insights and hopefully learn a thing or two.
Hello, my YouTube friends, and happy Friday. Hope everybody's doing well. A little out of shambles, unshaven, put some stuff to make my hair look a little bit better. But my wife's out of town. She had to go help her cousin. I've been trying to clean the house so she can come home to a nice and tidy place, a little bit surprised, which has kept me pretty busy, and I haven't had a chance to do any videos. Doesn't mean I'm not watching the markets, I'm not paying attention, and I don't listen to the news. That being said, I listened to Jerome Powell speak. Actually, all sounded pretty good, other than outlining that we have some risk in the market, which, to be fair to say, we've all been talking about, and it could have some continued downside pressure for a long time. Make sure to keep some cash on the sidelines, put yourself in a good position. I wouldn't get out of things, I wouldn't be panicking, I would just be going along with what keeps happening and trying to make decisions from there. When I was listening to Powell speak, I heard a couple of things in there that really struck my ears as important. With tariffs, he compared it to, the Great Depression and what went on with the Smoot-Hawley taxes and how it could potentially be the same, but that things are a little bit different and how it may not be the same. I think pretty reasonable to recognize there could be some problems. He also said that he expects inflation. However, in that comment, he reiterated that it may only be a one-time inflationary adjustment. So they want to keep that in perspective to make sure that we're not getting ahead of things if CPI comes in a little bit high for a month or two. Now, what that means is when the tariffs go through, their new costs to the retailers or whomever else, so prices may go up. But that shouldn't be a long-term continued expense. That should be like a once and done. Now, we all see what's going on with China, so that could be exacerbated a bit. But I think the Fed makes a really good point when they say that. The tariffs will go through, prices may go up, but they shouldn't go continually higher and higher because of a one-time adjustment for tariffs. Now, if we're slowing down already, which some of the data has been pointing to, it's possible that that causes us to slow down even more, and it could put us in a recession. The stocks are adjusting because of that. When there's more risk in the system and there's uncertainty, well, prices have to come down because the price to earnings ratios must be a little bit elevated if that wasn't in the evaluation prior. Do the earnings come down as well? And if they do, then yeah, we have a good ways to go. And it could last a while. I mean, that's the thing that you have to be prepared for. When you go back to some of the past recessions, things happened and took a couple of years. NASDAQ from the peak to the bottom was a little over a 2-year time frame, and the NASDAQ pulled back 90%. Now, do I see that happening this time? I don't think so, but I think the advent of online trading and more importantly phone trading may actually exacerbate the downsides. It may push it a little further with people's ability to just click on their phones and buy and sell things immediately. But I guess we'll see going forward. I do expect earnings of some companies to come down, but I also expect earnings of some companies to do better. I don't know how it would impact Netflix, who reported their earnings yesterday, and they were quite good, and they actually ended up over $1,000 a share by the end of the close. So I was really happy to see that. But companies like Amazon that seem to be having a tough time, or Google, maybe there's some things going on there that are going to put a little bit more pressure on those stocks. Now, in a set it and forget it account, I'm not making any changes. They're still great companies. I don't see anything that's changed in my perspective of Amazon or Google or some of the others. I think they may get pushed a little too far to the downside just because of the way ETFs work. And if people do end up getting into a position where they start panicking, if they start selling things like VOO or QQQ or any of those types of ETFs, they're going to push the Magnificent Seven down further than they should go because it's such a heavily weighted part of those indexes, and people don't realize that's what they're kind of buying when they buy those. I'm not saying that is going to happen, and like always, this is not financial advice. You guys need to do your own research when doing your own financial decisions. Reach out to a financial advisor and don't listen to me. This is just entertainment purposes only, because I don't know that I'm right. Maybe the markets just scream higher. I just don't know who's going to come in and start buying things. What I will say is it could change on the flip of a tweet. I mean, we have the tariffs going on. If there's a tweet this weekend that says, hey, we came to an agreement with China, everything's great, we're going to profit, we're going to bring manufacturing back home, then you're going to see the market go straight back up. It's amazing how sensitive to what the tweets are coming out of the Oval Office. I'm not really sure that that should really impact earnings the way that people think. What I do worry about is some of the things coming to fruition that the gloom and doomers were worried about. We do have a lot of debt, and now we have an erratic leader in place that is upsetting other foreign leaders and could have them start to pull away from the US and the US dollar. And that could implicate a lot of things going on in the financial markets, which is why they're getting all wacky. It's really interesting. I would keep an eye on the dollar if it's something that you don't watch. The weird thing is it's on CNBC so often lately. Generally, that means it's the end of a move, not the beginning of one. But I've been watching the dollar for the past 30 years, and it just feels like it had gone too far and gotten too strong. It kind of looked like it had reached the end of its range, in my opinion. So it would make sense, whether we have the president we do now or somebody else, that the dollar may have been reversing anyway. Also, before I forget, because I always wait to the end, and I don't know how many of you are even watching by then, or even now, if you could do me a favor and hit that like button, smash the subscribe button, even make comments in the comment section. I can't tell you how much I appreciate that. That helps YouTube's algorithm. It helps people find the channel. And if you're enjoying the content, I appreciate that it gets out there a little bit more. Now, one of the people in the comment section asked me to review a few stocks for them and let them know what I thought. So we're going to do that in a little bit. If you want to know what I've been doing with my portfolio before I get into the stocks they were asking about, really nothing has changed other than I've started using 3-month CDs to force myself to be patient with some of the cash I had on the sideline. I don't want to use any of it to get longer any trades or put in any new positions. I really want to save it on the sidelines to see how this plays out and what goes on going forward, so that I have some bullets in case things get really rough for a while. It feels to me like something has to break, and nothing has broken yet. You know, when we've had those big corrections in the past, the markets had a shot to the bow like they had currently, and then the markets weren't able to catch themselves and continued lower, which is what you saw with the NASDAQ when I used the example and why it took 2.5 years. And then as we got to the end, something broke, whether that was the great financial crisis where the banks were having trouble, or the internet companies started going out of business and the internet bubble, or things of that nature. So I think, unfortunately, at some point, we're going to see some companies that run into trouble, whether they actually go bankrupt, someone you don't expect, or a group of corporations that just aren't making it, that really are the last blow to the system. And then my goal is to actually wait until it's already caught itself and beginning to go higher, which may take a very long time, to put that money back in. And I actually plan to put it back into one or two things that I think look like a super bargain, and just be patient until then. I hope it would be like ripping a band-aid off and it happens quickly. But if that's the direction we end up going, I think it's going to take a little while to play out. If it isn't, maybe these are some bottoms because it's some nice fear out there and we see the market catch itself and then just start drifting higher. I see either of these as possible outcomes, which is why I think the recession has kind of gone to 50-50 or 60-40 on that betting site. I think it's pretty reasonable any direction of that could happen. So the four stocks that they asked me to review were Hershey, which their ticker symbol is HSY, Archer Daniel Midland, which is ADM, T. Rowe Price, which is, I think of it as TROW, TROW, and then one that I had to look up a little bit, which is Nordson, NDSN is the ticker symbol. And I'll tell you, in some ways, I liked all four. There were a couple things like Nordson I don't know enough about to really do a good analysis on. I'll tell you what I looked at just from looking at the numbers, but please, like, I know I say do your own research, but at least on Nordson, I wouldn't take my advice on that one anyway, because I'm not familiar with them. I don't understand the business, and it's just, you know, I'm not like Warren Buffett, so I don't mean this the wrong way, but I think he has a little wisdom out there that if you don't know about a business and you don't understand what they do, it's just not something to invest in, because there's so many options out there. Why bother worrying about the ones that you don't understand? Just stick with stuff you know. That's kind of all along like why I never had a company like Palantir. They were in the news enough that I felt like as a trade they might go higher, but I don't understand that business at all. At least with like Palo Alto Networks or CrowdStrike, I understand a little bit of what they do, but it's not like I have some deep understanding or get it like I can understand a Target, which is why I talk to them. Anyway, let's start with Hershey. I really like Hershey, and what I liked about all four companies is they're really using a very small percentage of their payout ratio to be able to pay their dividends, which for me in the market that we're getting into is a really valuable thing for any company. Because if we do, it kind of covers both ends of it. If we do have a slowdown and you're not using a large percentage of your payout, your income coming in to pay your dividends, well, if things slow down, you should still be in a decent position to be able to pay out those dividends anyway, and possibly even raise them just to make people comfortable that things are just fine, even if they've slowed a bit. So the only thing I didn't love about Hershey is they're trading around a 19, 20 times current earnings, which is fine, but it's a little high for me for a company like Hershey that I don't really see this huge growth potential going forward. At the same time, I think that's kind of the case with a lot of the stocks that are pretty what I would call safer right now, because I think people have rotated out of things they see as more risk into things like Hershey, which is why you saw it go up from like 100 and I don't know what was the low, around 138 up to, boy, it got up above 170 before it settled somewhere in the 160s. I loved it when it got down to 140 and actually talked about it in a couple of videos and picked some up. I wasn't planning to make it a trade, but when it went to 170 so fast, uh, I just kind of got out saying thank you. But it's actually a company I like and want to own. If I saw it drop back down into a 150 range or 140, I would for sure be considering to pick it up again. And it might be even something that I'd consider selling puts at. And I looked when you had asked about it, but there wasn't enough in them. They don't have enough volatility. It didn't look so interesting to me. But I like them as a company. I love the payout ratio, and I don't see the dividend being any big issue. Depending on where you own it from, like me personally, I'd either be keeping it or looking to buy more if it fell lower. But that's my thought on Hershey. Archer Daniels Midland is also one that I've talked about before, and I think they're a great opportunity. You're not going to get rich with a company like Archer Daniels Midland, but I liked it actually once they had that problem with the one of the officers lying on the books, because it drove the price down to where it's super attractive at this point. Now maybe it stays that way for a long time, but it's only trading, it's less than a 13 price to earnings ratio, which for Archer Daniels Midland that is a company that tends to be pretty consistently growing and in a space that it's a moat and they don't have a ton of competition. I think that's a phenomenal price to be getting in. They also have a 4.4% yield, which is a tiny bit stronger than where I think you can get treasuries or CDs right now. So I'm happy to take it in a company like Archer Daniels that's trading at a low valuation, and they're using 54% of their income. That's their payout ratio to pay that dividend. Also similar to Hershey's, like super low, so that if there is a slowdown or if they have to make some changes, they should be able to easily continue to pay out that dividend. That to me leaves some good upside. I think even right here, it's a good price to be getting in. If it got back down into the low 40s, of course, it would be even better. But you're only talking about a few dollars lower, and it's not a very volatile stock, so I don't really see it going any direction real fast. But keep in mind, before they had that scandal, it was trading above $70 a share and seen it as a fair valuation. I'm not so sure that that's an inaccurate valuation, and I wouldn't be shocked to see the price drift back up into the 60s or 70s, especially if the economy got rough and they were able to continue to drive earnings, which I think they're in the position to be able to do. Now, I don't know enough about their intricacies and what might be impacted by tariffs. I don't know if they get a ton of things from China to be able to run their machines or whatever. I also don't know if they're enmeshed in there and could probably do that research, but I think low enough PE, low enough payout ratio, that's a super attractive company. The only reason I'm not plowing into it is if the economy corrects, I want to have some cash around and don't want to have to make a decision on something that, anyway, that otherwise I really like Archer Daniels. And T. Rowe Price wasn't one I had looked at. I have one concern here, but outside of that, similarly, it looks super attractive. I mean, its PE ratio for current valuation is under 10, which I see as a great opportunity. Paying out like almost 6%. It was 5.69% when I looked at it, which is a great yield in a company that has under a 10 PE. And similar, it has a payout ratio of 55.5. So super low, and ability to pay that out. Uh, I see that as super attractive in any company. The only things I saw that I didn't love so much is it seems like they tend not to invest in growth. They do just fine when they do, but they're not like pushing to try to grow the company. Now, that might be because the space they're in is super competitive and people don't tend to move their accounts to open somewhere else. I know other companies do a ton of advertising. T. Rowe Price just isn't one that I see lots of marketing out there, and maybe they'd be better served to try to grow their business a bit. But the other thing is as the stock market goes lower, their income likely drops. So depending on what types of accounts they have, if they have what's called a wrap account, meaning an advisor that charges a percentage on a portfolio, well, as the market dropped 20%, those earnings literally drop 20% as well because the charge they make is going to be discounted by that 20%. On top of that, if the economy actually gets to the point that the market crashes, well, trading is going to drop as well. I still think they're a good company. I think something a little bit different that has the same type of yield and an attractive PE, but doesn't have the same market risk that a T. Rowe Price might, is a Prudential. I don't know that I would choose Prudential over T. Rowe Price, but it's something that I own a tiny, tiny bit of each just to kind of have them on my radar, and because I thought they were attractive. That's why I didn't want to heard the wrong way. I still think T. Rowe seems pretty attractive at the pricing it's at. I just worry if the market continues lower, their earnings are going to continue to decline as well. I think they're still okay to pay that dividend though. And then as I said with Nordson, sorry, it's not the clothing store, it's different. I don't know. They're like a good old boy Ohio manufacturer that I from what I read. Like I think they're probably a good company. Everything looks just fine. I just don't know a ton about them. I think that they're more in the growing phase, which is great, and maybe they grow at a rapid pace. But I don't want to give advice one way or another. Payout ratio is pretty low. Yield is only 1.7, but my guess is if they're in their growth stage, they need that money to reinvest and grow the company as well. Anyway, I hope everybody appreciated the video. I hope you like the breakdown on those four companies. Thank you for asking about them. I really like doing this. I like going and researching some of the things, even the one I didn't know. I'll probably continue to read up on it just out of curiosity. I think those are some great companies that you asked about. I assume they're all ones that you're invested in. I think that those dividends look pretty safe. So if you're a dividend investor and that's important to you, I think you're in good shape there. Obviously, again, the little like disclaimer, I'm not a financial advisor, so please don't take my advice on it. Just what I see when I kind of look on. I use E-Trade for my trading, and they have pretty good research on their site as well. So I just go on there. I don't use or sell any of those other ones. I don't see the necessity for paying a place to do a portfolio tracker or whatever else. But maybe I'm just old and set in my ways. Again, thumbs up, like, hit that subscribe button, make some comments. Let me know what you guys think. And if you have questions about stocks you've been watching or ones in your portfolio, by all means, make a comment in the comment section. I'll take a minute or two and take a look and see what I think.